$17 billion lost by one bank in a single year. 3 years before that record-breaking loss, Anglo-Irish Bank had been called the best-managed bank in the world. By the time the full damage was counted, every working person in Ireland owed roughly $15,000 for loans they never took out, made by a bank they never chose. And the people who made the decisions, most of them walked. This is not just an Irish story. It is the story of what happens when a country bets its entire future on a single asset class, when regulators are told not to look too hard, and when the people in charge convince themselves that rapid growth and sound growth are the same thing. The collapse of Anglo-Irish Bank didn't just wipe out shareholders. It triggered a national bailout of 85 billion euros, forced an entire generation of young Irish people to emigrate, and left behind a decade of austerity that touched every family on the island. Ireland went from one of the fastest-growing economies in the developed world to an IMF ward in less than 3 years. The warning signs were visible. Nobody wanted to see them. To understand the fall, you have to understand the rise, because the rise was real, and it was spectacular. In the early 1990s, Ireland was one of the poorest countries in Western Europe. GDP per capita lagged far behind the European average. Emigration had been a fact of Irish life for generations. Then, in the mid-1990s, everything changed. Low corporate tax rates attracted foreign capital on a scale the country had never seen. Google, Apple, Microsoft, and dozens of other multinationals built their European headquarters in Dublin. A young, educated workforce drove productivity numbers that made economists sit up. By the mid-2000s, the phrase Celtic Tiger was everywhere. GDP growth was running at 5, 6, sometimes 7% annually. Unemployment fell below 5%. Property prices in Dublin doubled, then doubled again. The country felt genuinely like it was getting rich overnight, and at the center of it all was one institution. Anglo-Irish Bank was not a conventional lender. It did not take retail deposits in any meaningful volume. It did not write mortgages for ordinary home buyers. It had one specialty: lending enormous sums to property developers. The bigger the project, the more leveraged the borrower. The more interested Anglo-Irish became. That was the model, and for a decade it looked like genius. By 2007, the bank's loan book had grown past 100 billion euros. It was expanding at 30% a year. Sean Fitzpatrick, the CEO who had steered the institution for nearly 2 decades, was feted at business conferences across Europe. The bank's shares hit 23 euros. International analysts competed to praise its management discipline. But here's what they missed. Anglo-Irish was not managing risk. It was concentrating it. The vast majority of its loan book was tied to commercial property, and a significant portion of those loans went to a small circle of Irish developers, men who had borrowed their way into property empires so large they needed Anglo-Irish the way Anglo-Irish needed them. It was a closed loop, and it was a single, enormous bet on one outcome: Irish property prices going up forever. In 2007, those prices peaked. Then they stopped climbing. Then they started to fall, slowly at first, then faster. The developers who had borrowed billions found that the collateral backing their loans was worth less than the loans themselves. The losses inside Anglo-Irish were beginning to crystallize, even if the outside world did not yet know it. But it gets worse. At the same time the loan book was souring, auditors began uncovering something else. Sean Fitzpatrick, the bank's celebrated chairman, had been secretly borrowing money from Anglo-Irish for personal use, hundreds of millions of euros, and disguising those loans from external auditors by temporarily transferring them to another institution at year-end, then returning them after the audit was complete. He had done this for 8 consecutive years. The bank's own auditors signed off. The financial regulator, long regarded as one of the lightest touch in Europe, did not act. When global credit markets froze in 2008, Anglo-Irish's funding model collapsed overnight. The bank had financed its massive loan book largely through short-term wholesale borrowing. When that market shut, there was no fallback. And then the Irish government did something that stunned the world. In September 2008, over the course of a single night, the Irish cabinet issued a blanket guarantee of all liabilities at the 6 major Irish banks. Not just deposits, all bonds, all interbank lending, all wholesale funding, everything. Total exposure, approximately 400 billion euros, more than twice Ireland's entire annual GDP. The government argued the guarantee was necessary to prevent a full bank run by morning. Perhaps it was. But it also meant that every reckless loan Anglo-Irish had ever written was now sitting on the Irish taxpayers' balance sheet. The losses that emerged over the following 2 years were staggering even to those who expected the worst. Anglo-Irish was nationalized in January 2009. When auditors got full access, they found a loan book that was catastrophically impaired. By 2010, the bank posted that record €17.7 billion loss. The government's total injection into Anglo-Irish alone eventually reached €34 billion. When the costs across all 6 guaranteed banks were added up, the final bill exceeded €64 billion. By November 2010, Ireland could no longer borrow in international markets at sustainable rates. The country accepted an €85 billion rescue package from the European Union and the International Monetary Fund. It was described in the Irish press as the most humiliating moment in the history of the state. Public sector wages were cut, social services were reduced, income taxes rose, hundreds of thousands of young Irish people left the country, the unemployment rate tripled. Sean Fitzpatrick was tried 3 times for financial offences. He was acquitted each time on various procedural and evidential grounds. He died in 2021. The developers at the center of the lending spree negotiated settlements, went through personal insolvency processes, and in many cases retained substantial assets. The regulatory officials who presided over the era faced no criminal accountability. The people who paid were the ones who had nothing to do with any of it. So what do you actually take from this? The first lesson is about concentration risk. Anglo-Irish did not fail because banking is inherently dangerous. It failed because it put nearly all of its exposure into one asset class in one geography at the exact moment that asset class was forming a historic bubble. Diversification sounds boring until the alternative is catastrophe. The second lesson is about regulatory capture. Ireland's financial watchdog was celebrated as business-friendly, light-touch, low-friction. That was considered a competitive advantage, right up until it wasn't. When the people responsible for catching problems have been told not to look too hard, the problems accumulate in the dark until the light comes on all at once. The third lesson is the hardest one. The people inside Anglo-Irish were not idiots or cartoon villains. Many of them genuinely believed Irish property was a one-way bet. They convinced themselves that the speed of growth was evidence of the quality of growth. That is the trap that catches intelligent people in every cycle, not fraud, not stupidity, but the slow erosion of the question, what if I'm wrong? The moment you stop asking that question is almost always the moment the answer starts to matter most. The same pattern plays out on a different stage every decade. Japan in 1989, the United States in 2008, Chinese real estate more recently. The asset changes, the story does not. If today's breakdown made you look at your own financial picture differently, at where your money is concentrated, whether that is one stock, one sector, or one type of asset, that reaction is worth sitting with. If you're looking for somewhere to start thinking about a more diversified approach, Robinhood is offering a free stock just for opening an account. Robinhood.com/referral. It is a start, not a solution, but concentration risk is literally the first lesson every collapse teaches. If you want more stories like this one, the real mechanics behind the biggest financial disasters in history, told straight with no hype, subscribe. A new breakdown goes up every week. One question before you go. The night the Irish government guaranteed €400 billion in bank liabilities, did they have any other choice? Necessary rescue? Or the worst financial decision in modern European history? Tell me below. I read every reply. And save this one. The next time someone tells you a market only goes up, you'll want to remember what happened in Dublin.